40% gone in 48 hours. Last Friday, silver investors around the world woke up to their worst nightmare, the largest single-day collapse since 1980. Portfolios decimated, margin calls flooding in, forced liquidations cascading across every exchange from New York to London to Shanghai to Hong Kong. $120 per ounce on Thursday morning, $84 by Friday close, $70 by Monday afternoon. $500 billion in market value evaporated into thin air. I watched it happen in real time. I saw the fear in trader reactions. I saw the panic selling. I saw accounts that had been built over years destroyed in hours. And then, just when it seemed like the carnage would never end, something strange started happening. Over the past 48 hours, silver has staged one of the most aggressive recoveries in modern market history. As of this morning, spot silver is trading at $92.44 per ounce. That is a 25% bounce from Monday's lows in just 2 trading days. Now here is what makes this genuinely unusual. And I need you to pay close attention to what I am about to explain, because almost every financial headline you have seen this week is telling you the same story. Silver was a bubble. The bubble burst. 1980 is repeating. The speculators got crushed. Order is restored. Get out while you still can. I'm going to show you, with data and evidence, why that narrative is not just incomplete, it is dangerously misleading. And if you base your decisions on it, you might be making a serious mistake. But that is not all. I am also going to explain what the next 72 hours could bring for silver. Because there are events unfolding right now, today, this week, that most people are not connecting to what is happening in precious metals markets. By the time this video ends, you will understand the full picture, the real story behind the crash, the real dynamics driving the recovery, and most importantly, what to watch in the critical days ahead. Let us start with the ghost that haunts every silver investor: 1980. If you have been following silver for any length of time, you have heard this story. But most people only know the surface version. They know there was a crash. They know some brothers were involved. They know it ended badly. Let me tell you what actually happened, because the details matter. In late 1979, 2 Texas oil billionaires named Nelson Bunker Hunt and William Herbert Hunt embarked on one of the most audacious market manipulations in financial history. Their goal was nothing less than cornering the entire global silver market. At the time, silver was trading around $6 per ounce. The Hunt brothers began accumulating, quietly at first, then with increasing aggression. Physical silver, futures contracts, options, anything they could get their hands on. By January 1980, they had amassed a position that defied comprehension: an estimated 100 million ounces of physical silver, another 90 million ounces in futures contracts. Together, this represented roughly half of the world's deliverable supply. Let that sink in. 2 individuals controlled half of the world's available silver. Their buying pushed prices from $6 to an astonishing $50 per ounce in just a few months. An 800% gain. Miners who had been struggling suddenly found themselves sitting on gold mines, or rather, silver mines. Jewelry became unaffordable. Industrial users panicked. The entire silver market was distorted beyond recognition. The Hunt brothers themselves were briefly worth over $6 billion in today's money from silver alone. And then came the day that changed everything. March 27, 1980, Silver Thursday. The COMEX exchange, which handles most of the world's silver futures trading, announced new rules, emergency rules. No more buying silver on margin. Liquidation only. The Hunt brothers, who had been using borrowed money to fund their corner, were suddenly required to come up with massive amounts of cash or liquidate their positions. They could not come up with the cash fast enough. Panic selling ensued. The price of silver, which had touched $50 just weeks earlier, plunged to below $11. In a matter of weeks, the Hunt brothers lost over $1 billion. They eventually declared bankruptcy. The brokerage firms that had lent them money nearly collapsed. COMEX itself came within hours of failure. The entire commodities market was shaken to its foundation. This is the comparison that floods every financial headline whenever silver experiences sharp volatility. And superficially, the parallels to 2026 seem obvious. Silver tripled over the past year. Speculative positioning reached extremes. Then prices crashed by the largest single-day percentage since that infamous period. But here is what the 1980 comparison fundamentally gets wrong. The Hunt brothers were manipulating an otherwise balanced market. Let me repeat that because it is crucial. The market itself was balanced. Supply roughly equaled demand. There was no shortage. There was no industrial revolution driving consumption. There was just 2 wealthy wealthy speculators with borrowed money trying to corner the market for their own profit. When their corner collapsed, silver returned to its fundamental value, around $11, which is roughly where it would have been without their manipulation. 2026 is structurally different, and unless you understand exactly how different, you cannot possibly make sense of what just happened or what might happen next. Let me walk you through the numbers, and I want you to really absorb these figures, because they tell a story that the 1980 comparison completely obscures. Since 2021, the global silver market has been in continuous deficit, not occasionally, not cyclically, not in a few years here and there. Every single year. 5 consecutive years. Demand has exceeded supply. The cumulative shortfall over this period now totals approximately 820 million ounces. Let me help you visualize what that number actually means. Annual global silver mine production is around 835 million ounces, so the accumulated deficit equals essentially 1 full year of global mine output. Imagine a bathtub where the drain is always slightly larger than the faucet. For 5 years, you have been draining more than you fill. Eventually, the tub runs dry. That silver came from somewhere. It came from above-ground stockpiles, inventories held in vaults in London, warehouses in New York, private hoards around the world. These reserves have been steadily depleted. And here's the question that should keep you up at night if you are watching this market. What happens when the stockpiles run empty? We are not there yet, but we are closer than most people realize. Now let me tell you where all that silver is going, because this is the part that makes 2026 completely different from 1980. The silver is going to industry, specifically 3 industries that are fundamentally reshaping the global economy, industries that did not exist or barely existed in 1980. First and most important, solar energy. Every photovoltaic panel on every rooftop, every solar farm, every utility-scale installation requires silver. The metal's unmatched electrical conductivity makes it effectively irreplaceable in the cells that convert sunlight to electricity. Now, I know some of you are thinking, cannot they just substitute something else? Copper, maybe? Or aluminum? The answer, at least for now, is no. Silver's conductivity is the highest of any element. Period. No substitutes come close for the electrical contacts in solar cells. Research continues on alternatives, but nothing commercially viable has emerged. But here is the development that most coverage completely misses. The solar industry is not just growing, it is undergoing a technological transition that dramatically increases silver consumption per panel. The previous generation of solar cells, called PERC cells, used silver only on the front side of the cell for electrical contact. The newest generation, called TOPCon and heterojunction cells, require silver on both the front and back. The math is simple but profound. TOPCon cells use approximately 50% more silver per gigawatt of generating capacity than PERC cells. Heterojunction cells use twice as much. As the global solar industry shifts to these more efficient but more silver-intensive technologies, the demand equation changes dramatically. A peer-reviewed study published in January of this year projected that by 2030, total silver demand will reach 48,000 to 54,000 tons per year. Supply, based on current production and realistic expansion scenarios, is expected to reach only about 34,000 tons. Do the math. That means supply would meet only 62 to 70% of demand. The solar sector alone could consume up to 41% of global silver supply. This is not speculation. This is not a conspiracy theory. This is material science meeting market mathematics. The second industry driving silver demand: electric vehicle. A typical electric vehicle contains between 1 and 2 ounces of silver. This silver is found in electrical contacts, battery management systems, power electronics, and various sensors. By itself, 1 to 2 ounces might seem trivial, but consider the scale. Global EV sales exceeded 15 million units in 2025. Projections suggest this number will double or triple over the coming years. Multiply 1.5 ounces by tens of millions of vehicles annually, and you get substantial demand. More importantly, as EV technology advances, silver content per vehicle is actually increasing, not decreasing. Autonomous driving systems require more sensors and computing power. Vehicle-to-grid connectivity requires more sophisticated power electronics. Advanced battery management requires more silver-based components. The third industry, artificial intelligence infrastructure. This one is newer, but the implications are enormous. Every data center that powers every AI model requires vast amounts of silver in its circuitry. Every server rack, every network switch, every power distribution unit. The world is racing to build AI capacity at an unprecedented pace. New data centers are being announced weekly, and every single one requires silver. Put these three industries together, solar plus EVs plus AI infrastructure, and you have a demand profile that simply did not exist in 1980. These are not speculative bubbles. These are fundamental economic transformations requiring a physical metal that cannot be easily substituted. But I have not even told you about the factor that might be most significant of all, and almost nobody is talking about it. China. On January 1st, 2026, something significant happened with almost no fanfare in Western media. China implemented new export controls on silver. Previously, silver flowed relatively freely out of China. Chinese refineries processed silver, and much of it made its way to global markets. Now, exporting silver from China requires approval-based licensing, the same regulatory framework that China applies to rare earth minerals. If you remember what happened with rare earths over the past decade, you understand why this matters. In 2010, China cut rare earth exports to Japan during a territorial dispute. The impact was immediate and severe. Prices for certain rare earth elements spiked by more than 10 times. Japanese manufacturers scrambled. The entire supply chain for electronics, clean energy, and defense was thrown into chaos. China controls about 60% of global rare earth production, and it has demonstrated willingness to use that control as geopolitical leverage. Now China is applying the same framework to silver, not because silver is rare in the same way as rare earths, but because silver is strategically important, essential to the industries Beijing is prioritizing for its own economic development. By restricting exports, China ensures that its domestic solar manufacturers, its EV producers, its AI chip fabricators have access to silver at competitive prices. Meanwhile, everyone else faces tightening supply. This is resource nationalism in action, and the silver market is just beginning to price it in. So when you hear analysts comparing 2026 to 1980, I want you to ask them a simple set of questions. Where was the structural supply deficit in 1980? There was none. The market was balanced. Where was the explosive industrial demand from solar, EVs, and AI? It did not exist. These industries barely existed or did not exist at all. Where were the geopolitical export restrictions from the world's largest consumer? They were not there. The concept of silver as a strategic resource was not on anyone's radar. The situations are fundamentally different. The comparison makes for easy headlines, but it obscures more than it reveals. Now you might be asking a very reasonable question. If the fundamental case for silver is so strong, why did prices just collapse by 40%? Excellent question. And the answer is not about fundamentals at all. It is about market mechanics, about positioning, about the difference between what an asset is worth and what it trades at in moments of panic. Let me explain exactly what happened. Over the past several months, an enormous amount of speculative capital flooded into precious metals. The rally that took silver from $32 to $120 attracted everyone. Retail investors opening trading accounts for the first time, institutional funds allocating to commodities, Chinese speculators betting on continued yuan weakness, algorithmic traders riding momentum. The positioning data tells the story in stark terms. The Commodity Futures Trading Commission reported that speculative net long positions in silver had reached multi-year highs. Open interest in call options had exploded to levels not seen in years. Leveraged exchange-traded funds, products that amplify silver's moves, had attracted billions of dollars. The iShares Silver Trust, ticker SLV, was at the center of a retail frenzy reminiscent of the meme stock phenomenon of 2021. When a market is positioned this heavily in one direction, it becomes vulnerable. Not because the fundamentals are wrong, but because too many people are making the same bet at the same time. Any negative surprise can trigger a cascade. The surprise came on Friday, January 30th. President Donald Trump announced his nomination of Kevin Warsh as the next chair of the Federal Reserve. Warsh is perceived as more hawkish on monetary policy than many of the alternatives who had been discussed. Markets interpreted his nomination as signaling that interest rates would stay higher for longer than previously expected. This interpretation strengthened the US dollar, and for silver, a stronger dollar is bearish. It makes the metal more expensive for international buyers. It makes non-yielding assets like silver less attractive compared to interest-bearing alternatives. But here's what you need to understand. A 27% single-day collapse is not a rational response to a slightly hawkish Fed chair. The move was vastly disproportionate to the actual policy implications. What happened was mechanical. When Warsh's nomination hit the news, some traders began taking profits, reasonable enough after a 300% 15% rally. But profit-taking quickly triggered something more dangerous. Silver futures trade on margin. Traders put down a fraction of the contract's value and borrow the rest. When prices fall, they receive margin calls demanding additional funds. If they cannot meet the margin call, their positions are liquidated automatically. As silver began falling, margin calls began hitting. Traders who could not or would not meet them were forced to sell. Their selling pushed prices lower, which triggered more margin calls, which forced more selling, a self-reinforcing cascade of liquidation. Then CME Group, the exchange that operates COMEX, made an announcement that accelerated the destruction. They raised margin requirements on silver futures by 15%. Let me translate what that means in practical terms. Imagine a trader with a silver position worth $100,000 on paper. Previously, they might have been required to maintain $15,000 in their account as margin. Suddenly, they were required to maintain $17,250. If they did not have that extra cash available immediately, their position was liquidated. This margin hike hit at the worst possible moment. Traders already under pressure from falling prices were suddenly required to post more cash. Many could not. The liquidations intensified. In the space of 48 hours, the market moved from extreme greed to extreme fear. Prices that had been driven by speculative euphoria swung to levels driven by forced liquidation panic. The fundamental case for silver did not change on Friday. The supply deficit is still there. Industrial demand is still there. Chinese export restrictions are still there. What changed was positioning. Leveraged speculators were flushed out. Weak hands were replaced by strong hands. The market reset. And that brings us to the recovery. Starting Tuesday, something shifted. Dip buyers began stepping in. These were not momentum chasers buying because prices were going up. These were value-oriented investors who recognized that prices had overshot dramatically to the downside. Forced liquidations, the mechanical selling that had driven prices lower, began to subside. The worst of the margin calls had been met or defaulted on. The panic was exhausting itself. But there was another factor supporting the recovery that has received insufficient attention: geopolitics. On Tuesday, a U.S. Navy F-35 fighter jet shot down an Iranian Shahed 139 drone that was aggressively approaching the aircraft carrier USS Abraham Lincoln in the Arabian Sea. The carrier was sailing approximately 500 miles from Iran's southern coast when the incident occurred. This was not an isolated event. Hours later, Iranian Revolutionary Guard forces harassed a U.S.-flagged merchant vessel called the Stena Imperative as it transited the Strait of Hormuz. 2 Iranian fast boats and a Mohajer drone approached the tanker at high speeds. According to U.S. Central Command, they threatened to board and seize the vessel. The USS McFall, a guided missile destroyer, responded along with U.S. Air Force support. The Iranians backed off, but the message was clear. Tensions between the United States and Iran are escalating. Why does this matter for silver? Because silver, despite its industrial applications, remains a safe haven asset. When geopolitical risks rise, when the possibility of conflict increases, capital flows into precious metals as a hedge against uncertain outcomes. Gold is the traditional safe haven, but silver moves with gold, often with greater volatility. When gold rallies on safe haven demand, silver typically rallies harder. The timing of these Iranian incidents is particularly significant. U.S.-Iran talks are scheduled for Friday, just 2 days from now. Diplomatic channels are open. President Trump has indicated willingness to negotiate. Iranian President Pezeshkian has signaled interest in dialogue, but at the same time, military tensions are escalating. Drones are being shot down. Tankers are being harassed. The situation could go either way. If Friday's talks succeed, geopolitical tensions ease, safe haven demand diminishes, and precious metals might face headwinds. If Friday's talks fail, or if another incident occurs, tensions escalate, safe haven demand surges, and precious metals rally further. This is why the next 48 to 72 hours are so critical. But wait, there is yet another layer of uncertainty that landed just hours ago. Senator Thom Tillis announced today that he is blocking Kevin Warsh's confirmation as Fed chair. Remember, Warsh's nomination was the catalyst for Friday's crash. Markets sold silver because they expected Warsh to be hawkish and keep rates high. Now Tillis says he will not allow a vote on Warsh's confirmation until the Department of Justice concludes its investigation into current Fed chair Jerome Powell. Powell. The implications are significant. If Warsh's confirmation is delayed, what happens to the Fed? Powell's term as chair ends in May. If no replacement is confirmed, who leads the central bank? What happens to interest rate expectations? What happens to the dollar rally that triggered the silver crash? The very narrative that caused the sell-off is now in question. The certainty that markets thought they had about Fed leadership has evaporated. This is the situation as of Wednesday, February 4th, 2026. Silver has crashed 40% from its all-time highs. Silver has rebounded 25% from its panic lows. The fundamental supply-demand dynamics that drove the 12-month rally remain unchanged. The geopolitical backdrop is heating up rapidly, and the political certainty around Fed leadership that triggered the crash is evaporating. Where does silver go from here? I will be honest with you. I do not know. And anyone who claims certainty about market direction is either lying to you or lying to themselves. Markets can do anything in the short term. Silver could continue recovering toward $100. Silver could roll over and retest the $70 lows. Silver could chop sideways for weeks while the market digests everything that has happened. What I can tell you is how to think about the scenarios. Scenario 1. Geopolitical de-escalation. Friday's talks between the U.S. and Iran produce a framework for continued dialogue. Tensions in the Arabian Sea subside. Risk appetite returns to markets. Safe haven demand for precious metals diminishes. In this scenario, silver might face near-term headwinds, but the structural supply deficit continues building in the background. Scenario 2. Geopolitical escalation. Friday's talks fail. Another incident occurs in the Strait of Hormuz. The situation deteriorates. Risk aversion surges. Capital floods into gold and silver as safe havens. In this scenario, silver could rapidly reclaim $100 or higher. Scenario 3. Fed uncertainty deepens. Tillis maintains his block on Warsh. Powell's term ends without a confirmed successor. The Fed's leadership is thrown into chaos. Markets lose confidence in U.S. monetary policy stability. The dollar weakens. In this scenario, silver benefits from both the weaker dollar and the increased uncertainty. Scenario 4. Fed uncertainty resolves. Tillis drops his opposition. Warsh is confirmed quickly. The dollar strengthens. Interest rate expectations firm. In this scenario, silver faces renewed pressure from the hawkish Fed narrative. The reality is that some combination of these scenarios will unfold, possibly in ways that no one anticipates. Markets have a way of surprising even the most seasoned observers. What I know for certain is this: the comparison to 1980, while emotionally satisfying for those who missed the rally, fundamentally misunderstands the current market. In 1980, there was no supply deficit. In 2026, there is a massive one. In 1980, there was no industrial demand revolution. In 2026, solar, EVs, and AI are transforming silver consumption. In 1980, there were no geopolitical export restrictions. In 2026, China is treating silver as a strategic resource. The crash was real. The pain was real. Investors who bought at $120 and watched prices plunge to $70 experienced genuine wealth destruction. That is not something to minimize or dismiss. But the recovery is also real. And the structural forces that drove silver from $32 to $120 over the past year have not disappeared because of 1 week of violent price action. Where silver ultimately goes from here will depend on factors that are still unfolding: geopolitics, monetary policy, industrial demand, speculative flows, the interplay of forces that no single observer can fully predict. For those monitoring this market, whether as current holders trying to decide whether to stay the course, potential investors wondering if this is an opportunity, or simply curious observers trying to understand what is happening, here are the factors worth watching in the days and weeks ahead. Watch the U.S.-Iran situation. Friday's talks are a critical inflection point, but even after Friday, the Strait of Hormuz remains a flashpoint. Any escalation could trigger safe haven flows into precious metals. Watch the Warsh confirmation process. Tillis's opposition creates uncertainty. How this political drama unfolds will impact dollar expectations and, by extension, silver. Watch the U.S. dollar index. The dollar remains the single most important short-term driver of silver prices. Sustained dollar strength creates headwinds. Dollar weakness creates tailwinds. Watch physical market indicators. Premiums in the retail silver market, activity in silver ETFs, and lease rates in London all provide signals about the balance between paper and physical silver. Watch China. How aggressively Beijing enforces its new export controls could meaningfully impact global silver availability over the coming months. This This has been one of the most extraordinary weeks in silver market history, the kind of volatility that destroys some portfolios and creates opportunities for others, the kind of price action that separates those who understand market structure from those who merely react to headlines. Whatever decisions you make based on this information are entirely your own. I am not a financial advisor. This is not investment advice. I have no idea whether silver will be higher or lower when you watch this video. Consult qualified professionals before making any decisions that affect your financial well-being. Past performance never guarantees future results. Markets can remain irrational longer than any of us can remain solvent. But if there is one insight I hope you carry away from this analysis, it is this: do not accept simple narratives about complex markets. The comparison to 1980 makes for compelling headlines. It satisfies our desire for neat historical patterns. It gives comfort to those who want to believe that bubbles always burst and normalcy always returns. But the silver market in 2026 is not operating under the conditions of 1980. The supply dynamics are different. The demand drivers are different. The geopolitical context is different. The monetary backdrop is different. The outcome will not be the same. What that outcome ultimately will be, genuinely, no one knows. The future is irreducibly uncertain. Anyone who pretends otherwise is selling you something. But understanding the real dynamics, looking beneath the simplified stories and lazy historical comparisons, is the first step toward making informed decisions in uncertain times. The silver story is not over. We are still in the middle of it, and the next chapter is being written right now. Thank you for watching. If this analysis was valuable, consider subscribing for ongoing coverage of developments in precious metals and broader financial markets. And as always, stay informed, stay skeptical, stay vigilant.